I'm Greg Hunter. Welcome to USAWatchdog.com. With us, return visit by money manager Peter Schiff of Euro Pacific Capital and Schiff Gold. Peter Schiff, thanks for joining us today on USAWatchdog.com.
Oh, my pleasure, Greg. Great to be with you again, and I appreciate all the good work that you've been doing.
Oh, thanks, man. Well, listen, it's lovely having you on. I mean, the networks, they're so stupid. You got a beautiful TV shot, and you know what you're talking about, yet they don't want to book you. But I will gladly book you. Listen, here's what bothers me about this whole money printing extravaganza. It's not that the Fed doubled its balance sheet since September of 2019. It is that nobody cares. You watch CNBC and MSNBC and CBS and 60 Minutes, 60 fake minutes, and nobody's worried about all the massive money printing. Should they be worried, and why?
Well, of course they should be worried. Look, there were more people that were worried back in 2009, 2010 when they tried it for the first time. I mean, I remember I was out there warning about it, and I wasn't the only one. I mean, I may have been one of the few people that was warning about the crisis before it happened, right? I was talking about the housing bubble and forecasting the financial crisis. But once it happened, there were a lot of other people that were very critical of QE, of 0% interest rates, of all the money printing. They were worried about the ultimate price that we would pay. That's why they bid up the price of gold to 1,900 in 2011. I mean, even Larry Kudlow, of all people, was worried about what the Fed was doing. But nobody is worried about it now. And the reason is, I think they've been lulled into this false sense of complacency in that we got away with it the last time. We were able to take rates to zero before. We were able to do quantitative easing 1, 2, and 3, and there was no negative consequence. We didn't have the runaway inflation. We didn't have a loss of confidence in the dollar. And so there was no price to be paid for what we did. And so now we can just do it again, except it's much bigger, right? That we're printing way more money now than we printed before. The balance sheet is growing way faster. But since we got away with it before, well, I guess we'll just get away with it again. And that is the attitude that people have. And I think they're completely wrong. I think that, they got lucky last time. And by the way, there were consequences. That's why the recovery was so weak. That's why Trump got elected, because all we did is inflate a bigger bubble than the one that popped. But now that this bubble has popped and it found the mother of all pins in the coronavirus that put a gaping hole in it, so the air is coming out much faster than it came out of prior bubbles. And now they're trying to reflate this thing. We are going to now suffer not only the consequences of what we're doing now, but of what we did back then, because we kicked the can down the road for a decade, and now we've caught up to it.
I'm watching the information here. Of course, you manage money, and you watch it more detailed than I do. But I just think a big marker is this trouble that was reported by Mall of America in Minnesota. I mean,
Oh,
they're
yeah.
missing payments. It's an unbelievable amount. They're talking about defaulting. I mean, this is a huge piece of commercial real estate. And I'm thinking, wow, this is just the tip of the commercial real estate iceberg, and a very big tip, might I add. But we have not seen really the default cycle happen yet, have we?
No. I mean, we've been kicking that can down the road too, and people have been, living paycheck to paycheck, and that's the same thing with small businesses. Their revenue slows down; they can't pay their rent on their commercial space any more than their workers can pay the rent on their condos or their houses, whatever they got, or their mortgage payments. And we were in trouble before the coronavirus, right? We already had this retail apocalypse going on. And I think the only thing that was propping up the commercial real estate was the artificially low interest rates. Take that away, and this bubble would have popped a long time ago. But now that we've, have this big self-inflicted wound on top of it, right? The coronavirus didn't impact a healthy economy. The economy was already sick. You see, so many people think that everything was great, right? Because Trump was talking about this economic boom that we had, like the strongest economy in the history of the world, and that all we need to do is, go back to that once we decide to turn the economy back on. But there's no going back to the way it was because we were in a bubble, and the bubble is pricked. The air has come out. There is no way. It's impossible to return to what we had. All we can do is return from depression to recession, but I'm not even sure how long that will last before we relapse right back into depression.
Are they going to have to? They won't. The problem, I think, the big problem is that we did away with bankruptcy. We did away with bankruptcy. People say, "How do you fix this? Bring back bankruptcy. Everybody's models will get into line. Everybody's risk tolerance will get into line." You mean me as a CEO could get zero? Yeah, that's right. You could get zero. But no, nobody goes bankrupt. I mean, isn't the problem is that we have is that there's no bankruptcy anymore, at least for the stuff that we find essential?
Yeah, look, we certainly have no problem letting the little guy go bankrupt. But when it comes to bigger companies that are, more in the public eye, we feel that we have to bail them out because the politicians think the political consequences of not doing something are too big a risk. But look, had we allowed more businesses to fail in 2008, the businesses that were around today would be in much better shape and they wouldn't be in need of bailouts. But because of the moral hazard involved in the bailouts and because now so many companies didn't bother saving for a rainy day because they figured if it rained, they'd get bailed out by the government, we now have an entire nation of businesses that had nothing. I mean, it's the same thing with consumers. I mean, if we had a healthy economy, where businesses and their workers had ample savings, right? If we had it all levered up, we would be able to shelter at home for a few months and go without revenue, and it would be okay. But that's not the type of economy that we built. We built a house of cards. And the minute the revenue stopped flowing in, nobody had any money. Nobody could pay their bills, and everything is imploding. And now that that credit bubble has popped, it is impossible for the Fed to reflate it. I mean, they're going to try, and they are trying. They succeeded in reflating a bigger bubble than the one that popped in '08, but it's impossible to repeat the trick again.
Are they going to have to allow? Is somebody up there thinking, okay, because Martin Armstrong brought this up. Yes, they're printing money, but they're destroying capital. Businesses are going bankrupt. Things are going out. They're destroying capital at 20 to 30 times that. He says, so we're not getting any inflation. And of course, he puts yet because of the capital destruction. Are they going to have to let more businesses than they'd like to go under to offset the money printing? So you have capital destruction and money printing on one side. I mean, you have this teeter-totter. Are they going to have to use bankruptcy as a tool, or are they just going to send us into Weimar Germany 1921 or whatever?
Yeah, look, that doesn't offset the damage being done by the Fed, but we have inflation, right? We have massive inflation. That's what the Fed is doing. Look at the money supply numbers that came out this week. Money supply up another, 250 billion in the week. I mean, it's, we're going up $1 trillion a month. Look at the balance sheet you mentioned. It just moved over 7 trillion this week. I mean, we could hit 10 trillion this year. So that is inflation, right? When you are expanding the money supply, you are inflating the money supply. That is the very definition of inflation. It is an expansion of the money supply. Deflation is a contraction of the money supply. The money supply is not contracting. It is expanding massively thanks to the Fed. Now, the question is, when is that inflation going to manifest itself in a way that is painful to Americans in that it causes prices to rise for consumer goods, right? When inflation causes stock prices to rise or real estate prices to rise, people think that's a good thing because they think they're getting rich, because the value of their assets is going up. And for the people who need to buy a home, it's okay that it's more expensive because the government's going to help you borrow the money to buy it, right? And then you could jump on that gravy train and make money as your assets appreciate. So when the inflation is fueling asset bubbles, everybody is happy. And they don't understand the economic imbalances that result from those bubbles and how they simply set you up for an even bigger crash. But when is all this inflation going to move out of the stock market, into the supermarket? And, obviously, I thought this would have happened a long time ago. I mean, I'm surprised that we were able to make it this far, but we are at the end of the line. So I do think that you're going to start to see it. In fact, we already are seeing price increases at the supermarkets, because if you think about what's going on right now in the economy, you have two things. You have people are not working, right? They're not at their jobs. They're sheltering at home. So they are not producing the goods that they used to produce. They're not providing the services that they used to provide. Yet many of those people are actually making more money doing nothing than when they were doing something. People are getting bigger checks from the government than the ones they got from their employers, except they're not contributing anything. So we're not producing as much stuff, but we are producing a lot more money to buy the stuff. So we have all this money increasing demand, and nobody is working, creating the supply. So this is the perfect storm, and we're already seeing prices go up. And initially, there were some prices that went down, right? As soon as the crisis hit, you could look at airfares that collapsed. All of a sudden, they couldn't sell tickets, and so ticket prices went down. They have since soared. Look at airline tickets now. They're more expensive than before because the airlines have responded by canceling flights and mothballing their planes. And now there's not a big supply of flights anymore. So if you do want to fly, if you're among the few people who wants to get into a plane, be prepared to pay through the nose. And the same thing is going to happen throughout the economy. There's going to be less supply. And so even though there'll be less demand, the price is going to be higher. And the people who do want to buy things are going to have to pay more. Now, when it comes to food, of course, people are always going to need that. That's not a discretionary item. And a lot of things that people really need and they have no choice but to buy are going to get more and more expensive because, nobody is asking, Greg, how are we paying for all this government, right? We're getting these massive bailouts, massive stimulus. Everybody is getting a check. The deficits are trillions and trillions of dollars, $3-4 trillion. Where is the money coming from? How are we paying for it? You don't get government for free. All of this spending is the equivalent of a massive tax increase on the American public. Now, government is not officially raising taxes. In fact, they're cutting taxes. So where is the government getting all this money that it's spending? Well, the Fed is creating it out of thin air, but that doesn't mean it's free. What happens is when the Federal Reserve creates money for other people to spend, the people that already have money, that money loses value. So what the government does through inflation is it transfers purchasing power from the people that have it to the people that are getting the government money. And so you pay the tax through inflation. The value of your money goes down, and so the price of everything that you have to buy goes up. So you end up buying less stuff because the guy that got the government check is buying some of the stuff that you can no longer afford. So this is what's going on. We are going to have this massive inflation tax, and that's what I am trying my best to make sure as many people as possible avoid it. I mean, my clients have been positioned to avoid this for a long time. And I think now the massive tax that I was preparing people for is about to hit them, even bigger than I thought.
Sweden, you were talking about this in the pre-interview saying, Sweden did a cost analysis and they figured out they couldn't afford to do with what we're doing and they've got no more deaths than anybody else. Talk about Sweden and what Sweden did as opposed to all these Western countries that just shut down and printed money.
Yeah, well, Sweden seems to have a more balanced approach, a more rational approach. I mean, hey, we knew from the very beginning that the most vulnerable people were the elderly and people who had other health factors that complicated their situation if they contracted COVID-19. And so what Sweden says, hey, if you're in this high-risk group, then you stay home, right? I mean, we're not going to force you to stay home, but, we think it'd be wise for you to stay home because if you get this thing, I mean, it could kill you. But we also knew that if healthy people caught it, they were going to recover. It was not that big a deal. And so why should the whole country shelter at home when there's only a handful of people that really had a risk of death? I mean, look, we get colds all the time. We get flus all the time. We don't not leave our houses because we might catch something. And so they didn't shut down their economy. Yes, maybe they have a few more deaths. I don't know. I mean, you look at the nursing homes, you look at the average age of the people who are dying. I think if you factor in for some other things, I don't think the Swedish situation health-wise is any worse than all these other countries that have paid a much bigger price. And we have no idea. Maybe the Swedes are building up the herd immunity. Maybe next year they're going to be in much better shape and we're going to all get sick. because we sheltered at home and we allowed our immune systems to be run down, as opposed to the Swedes who built theirs up. But one of the reasons I think the Swedes came to this conclusion is, look, they're not part of the European Union, right? They don't have the ECB to bail them out. They just have their own central bank and their own taxpayers. And I think they realized, hey, whatever damage we do, we've got to pay for it ourselves. And so they were more rational. You know, in the Eurozone, a lot of these countries were like, oh, well, the ECB is going to bail us out. I think it was even worse in America, because you had all of these state governors that said, you know what, we're going to shut down our economies, and it's fine if all of our citizens don't have a job, because the federal government's going to bail everybody out. They're going to write checks to all of our people. And in fact, now you have all sorts of people who are earning more money not working, thanks to the federal government, than they were when they were working. So the federal government and the Federal Reserve are basically insulating the states from the consequences of their decisions by bailing out all the citizens, by bailing out all the companies. And now those state governments actually want to be bailed out directly for the lost tax revenue, right? And a lot of these states were in a lot of trouble before COVID-19. They were already broke and they had underfunded pensions. And now they're using this as an excuse, right, to get all kinds of money. In a way, I think a lot of these states want to make their economies as weak as possible, so they're more in need of a bailout, so they can grab more money from the federal government. Had the Trump administration and Congress made it clear from day one, look, whatever decisions you guys want to make on a state level, live with the decisions. Don't push the consequences off on another state. You've got New York State demanding money from Washington. You got plenty of rich people in New York. You want to shut down your state? You want to spend money? Then tax your own people. Same thing from California. If you want to shut down your businesses, then tax your own people to cover the cost. Don't push it off on Washington and the Federal Reserve. But the moral hazard of the idea that all this is for nothing, that we can print all this money and it's the same thing as actually working and producing stuff and earning it, this is going to end in disaster.
You were talking about Sweden. One of the other things you said, too, I don't want you to come back to Sweden, but I am. You said they did a cost analysis. They said they looked at it and said, oh, you can't put a price on life. You told me this in the pre-interview. And you said, yeah, you can. We do it all the time. Talk about that.
Yeah, well, everybody says, well, maybe what Sweden did, had they locked everybody down, maybe a few, less people would have died. Well, that's true, maybe. But we do these analysis all the time. I mean, yes, life is precious, but to a point. I mean, right, the speed limit on the highway is what, 65, 75, 80, depending on where you are. Why don't we just have the speed limit 35? Because obviously, if people didn't drive faster than 35, we'd have fewer accidents. And when those accidents happen, we'd have fewer fatalities. We could save lives if we didn't drive faster than 35 miles an hour. Well, why don't we do it, right? Because we could save a life. Well, we've decided that it's not worth it, right? That the cost to society of it taking that much longer to get places, right? We've decided that even though we know if we drive 70, 75, there's going to be a few more traffic fatalities every year, we're willing to take that risk for the benefit of being able to drive faster and not have to drive slow. And there's all sorts of things that we do where we do put a price on life, right? We can't say, no. We have to spend whatever it takes to save one life. We don't. And especially, with the COVID situation, I mean, the average person who dies of COVID-19 is about the average age that people die. I mean, most people who are dying of COVID-19 are, they're in their 80s. I mean, if it wasn't COVID-19, they die of something, right? I mean, we just talked about, was it John Glenn's widow just died. She was 100 years old, and apparently she had COVID-19. So, she died of COVID-19. I don't know. She was 100. I mean, you die of a lot of things. My great-grandfather died at 105.
Wow. He
fell out of bed. And so, and that's why he died, because he fell out of his bed. If he fell out of his bed at 35, he would have been fine. Right, so when you're 105 and you fall out of bed, right? Did the fall kill you, right? Or was it the fact that you're 105, right? I mean, you have to look at these other factors. And if we're going to say, look, COVID-19, maybe some of the octogenarians may may die a little bit sooner. Look, my mom's about to turn 80. I mean, every year is precious. Every day is precious. But, you can't shut down the whole economy to slightly reduce the odds that she's going to get it. And she could decide for herself, as a grown woman, hey, do you want to go out and potentially risk getting COVID? Because I talked to my mom. She says, look, I don't have that many years left. I don't want to live the rest of my life like a hermit. I'd rather take a chance. Maybe I'll get it, maybe I won't. I mean, those are decisions that people should be able to make on their own. It's the quality of life, not just the longevity, how many years, but the quality. I mean, do you want to hunker down and just stay away from people, because you might get sick? I mean, because there's so many things that could go wrong, when you're older. I see, you go skiing, you see these old people out on the slopes, they like to ski. I mean, but obviously if they fall, when you get older, a lot of things that wouldn't damage you when you're younger and healthy. I mean, a lot of things complicated when you get older. So we should be making these decisions. But no, you're heartless if you ask any of these questions. But the crazy thing about it is we made all these decisions to do all these foolish things when we were already broke, right? Nobody bothered to ask the questions. Hey, we're all living paycheck to paycheck. How are we going to ask people not to work when we know the minute they give up that paycheck, they can't pay their rent? And if they can't pay their rent, their landlord can't pay their mortgage. And if the landlord can't pay the mortgage, the bank fails. And then what happens when the banks fail? I mean, nobody asked the question. Nobody understood how vulnerable we were before we made all of these foolish decisions. And the idea was like, well, it's okay. The government could just print the money, right? It's no big deal. I mean, everybody thinks that we could all go home and take, many, many months of vacation and just print all this money. Well, we can't do that. Now, so far, it looks like we can, right? Because the dollar hasn't cracked yet, right? The dollar is still up there. The bond market hasn't cracked yet, but it's going to, just because it hasn't happened yet. And by the time it happens, by the time there's a crisis, because the market finally gets it, it's too late to do anything about it. You can't say, well, we're going to wait until, there's a crisis before we decide to do anything about it. It's like, I'm going to wait for the bomb to explode before we try to defuse it. No, you want to defuse the bomb before it explodes, because once it explodes, then, then that's it. And that's what we're heading for now, is this massive explosion.
You have Euro Pacific Capital, as it says in your band in the background. You also have Schiff Gold, so you know a lot about gold. I had Jim Sinclair on, and he said this little quip, and it was a better comment than I even thought when I first heard it. And he said, the only thing constant is gold. Look at all the markets, look at everything. The only thing constant is gold. And sure enough, while we're sitting at about 1730, actually gold year over year is up for $400 or so. I don't know. Gold is it seems more and more wealthy people who have never been involved in gold are getting gold. Talk about gold and silver, if you will. What's going to happen in the months and years to come for hard assets?
Yeah, well, again, it's not so much that gold is gaining its value. It's just everything else is losing value. And gold is the one stable factor. It's the one thing that, governments can't create, right, out of thin air. You actually have to mine it into existence. And its properties, are enduring. I mean, the properties that gold has today, it'll have those properties in a year, in 10 years, in 100 years. And so it's the ultimate store of value, and it's a much better money than the paper stuff that everybody is creating. And so right now, what's happening is every currency in the world, other than the US dollar, is consistently hitting new record lows in terms of gold. You need more and more euros. You need more and more Aussie dollars or Canadian dollars or South African rands or British pounds, right, to buy an ounce of gold, right? It keeps happening. The one major currency that is not at a record low is the US dollar. And that is because right now, the dollar is actually losing value more slowly than these other fiat currencies. And so its gold price is not falling as quickly. But this is going to change. We are going to win the race to the bottom. I mean, right now, you still have all these dollar bulls out there who think we're the cleanest dirty shirt in the hamper, and that, there's a dollar shortage and everybody needs dollars because there's all this dollar debt. And so there's this demand for dollars. We are going to overwhelm the dollar demand with dollar supply, right? We're printing all this money. The Fed is buying all these bonds, and it's not just treasuries anymore. They moved over into muni bonds. They moved over into corporate bonds. They've even gone down, the credit quality into the junk bond arena. So this is it, right? They're going all in on QE. It's no limit, right? They're printing all this money. And so ultimately, the dollar is going to tank, right? It hasn't happened yet, but it will. And that's when the party really ends. That's when there's massive pressure on consumer prices. That's when there's massive pressure on interest rates. But before that happens, people in America need to convert their dollars into gold, right? Or silver, real money. And if you think the price of gold is going up now, while the dollar is the least weak of the fiats, wait till the dollar is the weakest of the fiats, because that's going to really accelerate the appreciation of gold, in terms of these currencies. And that's going to really, put gold in the spotlight as a replacement for the US dollar as the main reserve asset for global central banks. I mean, right now, the dollar is the main monetary reserve. Central banks around the world hold gold in reserves, but they primarily hold US dollars. Now, for a long time, they were getting interest on those dollars. Now they're not, and they're watching their dollars depreciate relative to gold. But once the dollar really starts to fall, right, then central banks are going to decide, you know what, we got to get more gold and have fewer dollars. We need to back up our currencies with real money. We can't back it with the dollar, because that's like backing it with nothing. So when the other currencies are going down against the dollar, it's against gold rather, it's not that big a deal. But when the reserve currency is going down against gold, it is a huge deal, because now it loses that reserve status to gold. And that is going to inflict a lot of pain on the U.S. economy, because we have taken advantage of being the issuer of the reserve currency to live beyond our means and consume what we don't produce and borrow what we don't spend. And all that's going to come to an end. But before it does, buy physical gold and silver. Yeah, get it from me at Schiff Gold. I mean, if you can find a better price, then buy from a competitor. I think we've got the best prices. We got the best quality. We don't deal in any of these collectibles. We don't do any bait and switch. We don't try to encourage leverage. We deliver, quickly to your house or wherever you're ordering it. So that's Schiff Gold. But also, I think the big money is going to be made in gold stocks. And, the gold companies have a lot of gold in the ground. They haven't dug it up yet. And a lot of that gold is not being assigned any value by the market, because the current cost to produce it exceeds the value of the gold in the ground. But once the price of gold is 3,000, 4,000, 5,000, wherever it's going, all of a sudden gold that had no value is going to have a lot of value. And so now the companies can mine it and make a bunch of money, but now the market can assign a present value to all that future income. And when you have all these hedge funds and all these endowments and pension funds that own no gold stocks, I mean, it's amazing to me. I watch on the financial media, and they're all trying to come up with the COVID portfolio. And what do you buy? Netflix, Peloton, Amazon, like all these different things that they think benefit. But they're missing the gigantic elephant in the living room, gold stocks. I mean, the biggest beneficiary of what's going on now is an inflation hedge. The Fed is creating inflation like it's never done before, and it's only getting started. So this could not be a better environment for gold. So the people who are buying gold stocks, I think, are going to clean up. And by the way, I own the fastest growing gold fund in the United States right now. My NAV of my gold fund has grown more this year than any of the other funds. There's not that many. There's about 70 something funds. So it shows you not that many gold funds. But mine is the fastest growing. I think it will be the best performing. I mean, right now we've given back a little performance. I was the best performing fund in the category for the 5 years ending December 2018, for both 5 years and 3 years. I got a plaque from Lipper for being the #1 fund, and I had 5 stars by Morningstar. We lost the star now because we've given up some performance in the last year and a half because we have a lot of juniors that haven't really moved as much as some of these senior companies. But I think we're going to catch up. I think we've got a great portfolio. I think we're going to go back from 4 stars to 5 stars. Before we do, you should buy it, right? It's if you're willing to take the risk. Obviously, there's a lot more risk in gold mining companies than just in physical bullion. I look at physical bullion as just a safe haven store of value. And obviously, gold stocks are speculative business. A lot of stuff can go wrong, but a lot can go right. And I think the risk reward is heavily skewed right now. the amount of money that you can make if I'm right dwarfs the money that you would lose if I'm wrong. So as long as you're willing to lose the money in case I'm wrong, then make the bet that I'm making. And I think my gold fund, Euro Pacific Gold Fund, EPGFX, is a symbol. You can go to EuroPacificFunds.com and buy it directly. We're also on Schwab, Fidelity, E-Trade, all sorts of discount brokers. I have 5 mutual funds in my family, so you can buy these mutual funds any place that has me on the platform. More companies are adding it all the time. But the one that I think is really positioned to make the most money right now is the gold fund. But clearly, it has the most risk.
That is that's a great pitch. I mean, I don't get paid anything. I have you on because I think you're a smart guy. But that's actually that's a very compelling pitch, frankly.
Too, I was smart enough not to manage the fund myself. See, I'm here doing interviews with you. I hired Adrian Day, who is the smartest gold guy I know.
I know him.
He's been doing this for
I know
30,
of him.
40
I don't know
years.
him. But yeah.
Yeah, he's been doing this for 30, 40 years. There's a whole idea about the efficient market, where they say, hey, you don't need a manager because all the information is out there. So just buy an index fund because nobody can beat the market. Well, that's definitely not true when it comes to gold stocks. Nobody knows gold stocks like Adrian, right? He knows the companies, he knows the management teams, he knows the projects. I mean, we've had a huge bear market. The smartest people on Wall Street are not managing gold funds. They're not analysts. I mean, they're doing something else. I mean, that's for losers, right? Because it's been like consigned to the fringes. But he's a smart guy that's been in this for 30, 40 years. He went through the ups and downs. So I don't think there's anybody really that can compete with him. I think that we have a real edge when it comes to Adrian, and I think we're going to kill the market. Instead of just buying everything, I think we're going to buy the good stuff and avoid the bad stuff.
Yeah, Adrian Day is a well-known gold. Even I knew who he was, and I'm not that much of an aficionado.
Yeah, he's managing my gold fund for me.
Last question. I just want to talk about this. We're out with another couple of million people. We're at, 40 million people. In the Great Depression, it took 2.5 years to have 12 million people lose their jobs. We had 90 million people or so in the country. Now we have 320 million people, but a staggering 40 million people, around 40 million people have lost their jobs in 8 or 9 weeks? I mean, people talk about this is going to be worse than the Great Depression. You look at all the metrics. Is this one of them that tells you this massive loss of employment on many jobs won't come back? Does this metric tell you how bad this is going to be?
Sure, and in fact, it would have been worse if we weren't paying so many companies not to lay off their people. Where they'd be better off with the layoffs. But sure, part of it is self-inflicted, right? Obviously, if we hadn't ordered all these businesses to shut down, more of them would have remained open. But a lot of these jobs were going to be lost anyway. We've simply accelerated a process that we have been postponing with cheap money and bailouts. So I think that now that we've, advanced the ball here, it's not like all these jobs are coming back. I think some of these jobs will come back. A lot of them won't. But a lot of the jobs that come back won't stay back, because I think when a lot of businesses recall their employees, they're going to realize that they actually don't need them or they can't afford to employ them anymore. Because, one of the other bad things that we did during this crisis is we now have mandated medical leave, mandated family leave, which dramatically increases the cost and the risk associated with employing people, because now employers know, hey, if we have a relapse, we have a second wave, all my employees get time off, I got to cover all the costs. And also, I think when the economy does reopen, it's not going to reopen back to the way it was. I mean, a lot of people don't have as much cash to spend, but a lot of people don't want to go to restaurants. They don't want to take a chance, right? They don't want to go to movie theaters. They don't want to travel right now. Even if they have the money, they'd rather not do it. So a lot of these businesses are not going to get the revenues that they need. A lot of these businesses are relatively low margin. They need a certain amount of volume. And without that volume, they can't stay in business. And of course, now a lot of companies are going to have the added cost of having social distancing, all the stuff that they're going to have to do to supposedly keep everybody safe. That is going to add cost, right? To keep their workers safe, to keep their customers safe. And of course, now there's higher liability, because what if somebody gets sick? Now you're going to get sued. So it's a lot more expensive and risky to operate a business now in an environment where a lot of people are unemployed and don't have any money. So we've really got this thing going, this recession started, but we're making it worse by growing government and further incentivizing people not to work, but to collect unemployment benefits instead. What we really need to do is shrink government. We need to cut government spending and free up those resources back into the private sector. Instead, we're making government bigger at the time where we could barely afford the government we got, let alone an even bigger one. And everybody just thinks we're getting it all for free. We're not. We're going to pay through the nose. The most expensive way to pay for government is the way we're doing it now, by printing the money. And so if you don't want to pay that tax, as we said earlier, buy gold, buy silver, buy gold and silver mining stocks. If you want to take a less risky approach, right? The majority of the money that we manage is not in gold stocks. We have a very significant allocation, which is now much bigger based on how well these stocks have done recently. But most of our money is in basic dividend-paying stocks in countries that are financially on much sounder footing than the United States, so that the companies are earning revenue in currencies that will retain more of their value, and therefore they're paying us dividends that will go further when it comes to buying the stuff that we need. So if you don't want to, go all in on gold stocks, which you probably shouldn't, there's a lot of good dividend-paying stocks that we're buying for clients all around the world in countries like Sweden and Norway, by the way, and New Zealand and Australia and Hong Kong and Singapore. There are countries that are in much better shape than the United States. They have trade surpluses or budget surpluses or sounder policies, and their assets are at better valuations. The stocks in these countries trade at lower PEs. The dividend yields are much higher. So I think, you can be in the stock market, just don't be in this stock market. There are other stock markets where the companies have much better values, and I think you're going to have much better long-term returns. Yes, over the last decade, it was great to be in the U.S. stock market because the Fed succeeded in inflating the bubble. Well, now that bubble is going to completely implode, and no matter how much they try to reflate it, all they're going to do is destroy the dollar instead.
And one last question. With the metrics about the unemployment, 40 million people unemployed. Is it hyper? I don't know. Is it being a hyperly fearful to say this is going to be the greatest depression ever?
No, it could be. In fact, we're going to make it the Great Depression. That's the reason that we had a Great Depression. That wasn't something that happened naturally. The government created the depression by I think, the Federal Reserve was too loose, especially in the latter part of the 1920s. The early part of the 20s was a legitimate boom, but in the last few years, they kept interest rates too low. They were trying to help the British and protect the pound from falling against the dollar, so that extra liquidity that they created spilled over into the stock market, it spilled over to the real estate market. The bubble popped in 1929. Had the government just done nothing and let the bubble pop the way they let the bubble pop in the year in 1920, had they done nothing, we wouldn't have had a Great Depression. We would have had a drop, a severe recession. It would have lasted maybe a year or two, and then it would have been over. But instead, Hoover ignored the advice from his Secretary of the Treasury, which was actually probably the last time that the Secretary of the Treasury gave any good advice to a president. But the advice back then was to do nothing. And Hoover was like, I can't do nothing. I got to do something. And so they had all kinds of intervention to try to prevent companies from cutting wages or lowering prices. And they had all kinds of other bailouts, and that's what turned it into a depression. And then Roosevelt made it a Great Depression. Once he got elected in 1932, he simply expanded the failed policies of Hoover. And so the depression went all the way through the Second World War. We weren't really out of the depression until the war was over in 1940, 45, 46. So, people want to credit Roosevelt for ending the depression. He helped cause it. We got out of it eventually, despite all the bad things that Roosevelt did. And so now we're doing those same things, except we're doing them from a position of extreme weakness. We were a much healthier economy in 1930 than we are today. And so this could be much worse than the depression. The government now is positioned to do far more damage than we did then, except now we're not on a gold standard. We have the Fed that's committed to just running the printing presses, nonstop. And so this could be an inflationary depression we could have hyperinflation. We didn't have anything like that. During the 1930s, prices went down. That was a relief, right? People got the relief of lower prices. So that made the downturn not as bad because, things didn't cost as much. But imagine having that type of unemployment or higher with the cost of living skyrocketing. Right? So that's what we're heading for. It's going to be like the 1970s, only on steroids, because it's going to be a much deeper economic contraction with a much bigger increase in prices, consumer prices.
Peter Schiff, Euro Pacific Capital, Schiff Gold. I'll put the links up in the after the interview section. There's all kinds of information, free information on there. You have a podcast as well. You got a TV studio, dude. Thanks for coming on and taking us to school on today's early Sunday release and giving people a cold bucket of water in the face to let them know that this is not going to end very soon, and it certainly isn't going to end well. We're just, I got it. We ride over the roller coaster. We're doing this. We haven't reached critical speed at the bottom of the track.
Yeah, but at least, Greg, between your podcast, what you're doing with USA Watchdog, I'm doing the Peter Schiff Show, schiffradio.com or YouTube. I mean, we're getting the information out there. Our audiences are building. And I think as these events play out and the mainstream media continues to be wrong and parade one person after the other with the same nonsense, more and more people are going to discover our platforms, and we're going to help build the audience and educate the public to really understand the source of the problems and what then the solutions that will actually work.
Peter Schiff, thank you for joining us today on USAWatchdog.com.